Hey, what's up, stock compounders? Brad here. Today, I want to give my highlights from a recent Jeremy Grantham interview on the Investors Podcast. What's remarkable about this episode is it went viral on YouTube. If you look down, 229,000 views less than 2 weeks ago, and there's no video. Okay, I think it's pretty rare for an audio-only podcast to go viral on YouTube. But I listened to all 51 minutes, I think twice actually, and I just want to share my highlights. And to make it easier, I created a Twitter thread of my highlights from this interview. So probably the easiest thing is just to work through the Twitter thread. There's only like 12 tweets in the thread. Grantham is starts talking about bubbles, right? Bubbles in the stock market. He says, great bubbles are always easy to spot, and it's always claimed that they are not, right? Like there's some mystery. It couldn't have been foreseen what was about to happen. He says they stand out like a Himalayan peak out of the plain. These are 2.5 sigma to 3 sigma events, the kind that occur every 50 to 100 years. And I just want to point to what Grantham is referring to, how these things really stand out if you're looking at the data. So the Buffett indicator, some of you might be familiar, the ratio of the total U.S. stock market value divided by gross domestic product. This was named after Buffett, who called the measure the single best measure of where valuations stand at any given moment. It looks like he's walked those comments back since then. But, Buffett basically didn't want to endorse a single measure. But we're going to take a look at it. So the most common measurement of this aggregate value of the U.S. stock market is the Wilshire 5000. So let's take a look. This is the Wilshire 5000 total U.S. stock market value. It doesn't tell us much by itself, but if we compare it to GDP, this is the Buffett indicator, okay? If you look at, you can kind of see end of 68, 69, kind of a peak here. This is the trend line, this gray line. You can see here the dot-com bubble, and you can see here just about a year and a half ago, okay? So those sure seem to stand out, but let's look at the standard deviation lines overlaid on this data. So we can see the dashed red line is 2 standard deviations. So you can see it got there in the late 1960s. It exceeded that 2 standard deviations in the dot-com bubble. You can see didn't get there, didn't get even close in the housing crisis. But look at where we were just over a year ago, okay? Exceeded that 2 standard deviations for the Buffett indicator. So that's what Grantham is talking about. When he says these bubbles stand out like a Himalayan peak out of the plain. So I just wanted to pull some data into the conversation here. The next point, most of the decline in these great bear markets only happens after the first interest rate cut. Okay, and of course, we haven't seen the first interest rate cut yet. We've just been seeing interest rates rising to try to beat down inflation. You tell me when the first interest rate cut is, and I'll tell you when the second half of the pain is going to start. This correction will likely run deep into next year. Okay, this happened just a few weeks ago. So Grantham is pointing out he thinks this thing could run deep into 2024. We have forgotten to inflation adjust the market figures because we haven't had meaningful inflation for 20 years. We've had over 10% inflation. So when people say the market's down 15%, the S&P is down 15%, it's actually down 25% if you factor in inflation, which we're just not used to doing because we haven't seen this level of inflation in like 4 decades. So he says 25% is a pretty decent down payment on this bear market. The next point, we knew we'd have more buy the dip this time than ever before because of the $1 trillion lurking around in the piggy banks of U.S. citizens from COVID stimulus. The third phase, which relates to business fundamentals, is the difficult one. Okay, and we haven't really gotten there yet, according to Grantham. How long and painful will that adjustment phase be? Now, Warren Buffett, in his talk with Becky Quick, I think it was last week, he alluded to this third phase where the fundamentals really get hurt. This is another Twitter thread I did, tweet 30 in this thread. Buffett was asked, where are we now with the economy? And he points out that one of their retail businesses, Berkshire Hathaway's retail businesses, is down 22% on sales. And that's from February 2022 to February 2023, down 22%. He says it's a tougher world out there in a great many businesses. Okay, so this, kind of signs of fundamental deterioration. It's out there. The data is starting to show up. So the next thing, the American corporate system has developed a style that makes it almost possible to break the law legally. Stockholders are leaning on corporations to take it easy on CapEx, capital expenditures, opening new plants. This generates an economy of mild shortage all the time. So this is kind of the lead up to Grantham really dropping a doozy here, saying he thinks stock buybacks should be illegal. Okay, so it's a very bold claim, especially what Buffett recently said in his letter to shareholders. Kind of takes the opposite perspective of that. Buffett said something like, anybody who thinks all buybacks are bad is an economic illiterate, effectively. Profit margins have risen steadily, which is wonderful for corporate profits and shareholders, but terrible for the economy and terrible for equality and wages of workers. U.S. wages are still stuck back in hourly rates adjusted for inflation of the late 1970s. And Grantham points out how, in France, in other European countries, wages have grown a lot faster than they have in the U.S. So, this corporate system, how it's evolved, Grantham thinks, has really favored owners and shareholders over employees. So I haven't really heard that argument made before. So that was probably my biggest surprise from this whole Grantham interview. Capitalism is not designed to look out for the long-term well-being of society. Okay, capitalism, it's really designed to capture short-term profit. It's fantastic at that. But of course, it's led to some of the problems that we're facing currently as a society. In 1990, the companies under 1 billion, I think that's in market cap, made 8% return on sales. Those over 10 billion, so kind of the large cap universe, made 12% on sales. And Grantham's saying, that's kind of to be expected. You get a bit of a boost in profit margins with economies of scale. That's what you might expect. Now, the data from today, this is 3 decades later. Companies under $1 billion made 4% return on sales versus 18% for companies over $10 billion. That's what you expect to see when the system is being run for the benefit of large corporations. Okay. So another trend he's kind of pointing to here, the first being wages really not keeping up with the growth of companies. And now we got this growing gap between small companies and large companies in terms of profitability. Just a moment. Okay, we're almost done here. The FANGs, and I would throw Microsoft in here as well. FANG'em is what Damodaran has labeled that. Account for 80 to 90% of all the superiority between the US system in the last 20 years and the rest of the developed world. Okay, so it's really the big tech companies in the US where virtually all of the outperformance has come from. And every one of these companies came out of the VC industry. Now, Grantham is very involved in the VC industry for tackling some of these problems we're going to get to in a minute here. The commercial imperative is to be bullish. Now, here Jeremy Grantham is clapping back at this label that's been put on him as perma-bear, right? People dismiss Jeremy Grantham because, they say he's always bearish. But Grantham is pointing the finger back. He's saying the industry as a whole is bullish, okay, perma-bullish. You'll never make as much money as a financial institution being bearish. The optimal flight path to long-term profit is to be resolutely bullish, perma-bull, okay? One of the things that really irritates the perma-bulls, the institutions, is when others are bearish. They immediately cry out, perma-bear, perma-bear. Any good propagandist will accuse the enemy of exactly what they're doing. Don't expect any clear-cut bearishness from the financial world in general. Okay, it's not how they make money. And finally, we're going to talk about the issues that Grantham worries about. And these are some issues that he's really focused on in the VC world. The issues that I worry about are under-recognized long-term problems. Things that capitalism really isn't very good at tackling. So we've got climate change, resource shortages, population decline, and toxicity. Just level of toxins in the environment. He says toxicity could be a bigger problem than climate change. And he points to toxicity as a big cause of decline in fertility, which is affecting this population decline. So, there's a lot of kind of overlap between these. But I was surprised he pointed out toxicity as potentially being a bigger problem than climate change. Of course, any chemicals, any pesticides you put in the environment, water is nature's ultimate solvent, right? There's the water cycle. Air moves everything around. So you got this water and air, these fluids of earth that are circulating everything that we put into the environment. And that's becoming a problem, that we've dumped so much toxic stuff in the environment. He says, I think venture capital is our best shot at digging out of all of these problems. So again, this is where he's heavily focused in terms of investment. That's it, guys. I just wanted to kind of share those highlights from Jeremy Grantham. It's always a little bit tough to listen to him because it's hard to get kind of the kind of negative view on reality. But I don't dismiss it because I think there's a lot of truth in there. And for truth seekers, it's easy to fall into this trap of denial, right? It's a psychological bias that all humans have. If there's something we don't like, we just kind of deny that it exists, that it's true. But that's not really a rational approach forward. So I like to take all this in, trying to not let it affect me too much. But, you know, I respect Jeremy Grantham. And I'm hoping at some point there's a time when he's not bearish, right? Although that will mean there's blood running in the streets. So be careful what you wish for, right? Anyway, guys, thanks for watching. That's all I got. And I'll see you all in the next one. Take care.